Before we begin, please remember that the information provided in this video is for educational and entertainment purposes only. I am not a licensed financial advisor, and this presentation should not be considered financial, legal, or tax advice. You should always consult with a qualified professional before making any decisions regarding your mortgage or personal finances. All financial strategies involve risk, and there is no guarantee of any particular outcome. Picture this. It's the first of the month. Your paycheck just landed in your bank account, and for a fleeting glorious moment you feel a sense of relief, maybe even a little bit of wealth. Then you see it. The notification. The automatic withdrawal that feels less like a payment and more like an amputation. The mortgage. That one single transaction that carves out a massive chunk of your income, month after month, year after year. For millions of Americans, it's the single biggest expense they will ever have. A financial black hole that can feel like it's sucking the air out of your budget. We're told it's the price of the American dream, but for so many, it feels more like a 30-year sentence in financial prison. What if I told you that you have the keys to that prison? What if you could shrink that black hole not by a little but by a lot? What if you could systematically dismantle the very structure that's designed to keep you paying the bank for decades? Over the course of this presentation, I am going to give you those keys. We are going to pull back the curtain on the mortgage industry and expose the exact, actionable strategies that lenders and banks often hope you never discover. We're not talking about flimsy, generic advice like skip the daily latte or make a budget. That's like trying to stop a tidal wave with a paper towel. We are talking about concrete, powerful financial maneuvers that can slash your monthly payment, incinerate years off your loan term, and save you tens or even hundreds of thousands of dollars in interest. This isn't theory. This is a battle plan. A plan to reclaim your financial freedom, one payment at a time. For years, I was right there with you. I remember sitting at that closing table, signing a mountain of paperwork my hand could barely keep up with. I felt that mix of pride and sheer gut-wrenching terror. I nodded along as the loan officer explained the terms, but all I really understood was the gigantic number I'd have to pay every month for the next 360 months. I accepted it as a fact of life, the unavoidable cost of owning a home. It wasn't until I started digging into the fine print, into the very mechanics of how these loans are structured, that I had a shocking realization. The entire system is tilted against the borrower. And the biggest myth, the cornerstone of this entire system, is the so-called gold standard of American homeownership, the 30-year fixed-rate mortgage. We're taught to see it as safe, stable, and predictable. And it is. It's predictably one of the most inefficient and expensive ways for a consumer to finance a home. Think of your mortgage amortization schedule as a giant seesaw. On one end, you have the principal, which is the actual money that pays down the loan on your house. This is the part that builds your equity, your wealth. On the other end of the seesaw, you have interest, which is the bank's pure profit. It's the fee you pay for the privilege of borrowing their money. When you sign for a 30-year mortgage, the bank doesn't just put that seesaw on level ground. They bring in a crane and tilt the interest side so far down it's practically scraping the floor. In the first year of a $400,000 loan at a 6.5% interest rate, you'll make over $30,000 in payments. But guess how much of that actually goes to paying down your house? A little over $4,000. That's it. The other $26,000 is pure interest, vanishing into the bank's pocket. For the first 10 to 15 years of that loan, you are essentially a high-paying tenant in a home you supposedly own. You're renting money at an exorbitant price, and your payments are barely making a dent in what you actually owe. The system is designed this way. It's front-loaded to ensure the bank gets its profit first, locking you in for the long haul. So how do we fight back? How do we start tilting that seesaw back in our favor, so our hard-earned money builds our wealth, not the bank's? The first technique is elegant in its simplicity, yet profoundly effective. I call it the 13th month miracle. And no, it doesn't require you to magically get a 13th paycheck every year. Here's how it works. You make 12 monthly mortgage payments a year. The strategy is to make one extra mortgage payment over the course of those 12 months, but, and this is the critical part, you apply it entirely to the principal balance. The easiest and most psychologically effective way to do this is to take your monthly payment amount, let's say it's $2,400, and divide it by 12. That gives you $200. Every single month, when you make your regular $2,400 payment, you add an extra $200. But you must explicitly instruct your lender that this extra $200 is a principal-only payment. You cannot just send in extra money and hope for the best. If you do, many lending systems will simply apply it to your next month's payment, covering the interest first, which defeats the entire purpose. You have to be specific. Go on your lender's online portal or call them, and ensure that extra amount is coded to go directly toward reducing the loan balance. That extra payment bypasses the interest side of the seesaw entirely and goes to work for you, not for them. What kind of difference can this small change possibly make? It's staggering. Let's go back to that same $400,000, 30-year mortgage at 6.5% interest. By simply adding that extra principal payment each month, the equivalent of one extra payment per year, you would obliterate more than 4 years off your loan. You would be mortgage-free 51 months earlier. And the savings? You would save over $71,000 in interest payments. Let me repeat that. $71,000. For the price of a few streaming subscriptions or a weekly pizza night, you just bought back 4 years of your life and kept the cost of a brand new luxury car in your pocket. This is the power of attacking the principal directly. Every extra dollar you put toward the principal is a dollar that the bank can no longer charge you interest on for the entire remaining life of the loan. It creates a snowball effect that accelerates your path to freedom. Now, a couple of crucial points. Before you start, you must check your loan documents for something called a prepayment penalty. While they've become much less common, some loans, especially older or non-traditional ones, might have them. A quick call to your lender can confirm this. Secondly, you need to verify their process for making principal-only payments. Can you do it online? Do you need to mail a separate check? Do the work once to set up the system, and then you can automate it and let it run on its own. This 13th month miracle is just the beginning. It's the foundational play in our book. It's powerful, it's accessible to almost anyone, and it immediately shifts the financial dynamic in your favor. But it's just the warm-up. As we continue, we are going to escalate our attack. We'll uncover a little-known strategy called mortgage recasting, which I call the secret cousin of refinancing. It can dramatically lower your monthly payment without you ever having to change your interest rate or go through the hassle of a full refinance. We will expose the truth about private mortgage insurance, or PMI, and I'll show you how to get rid of that parasitic fee years ahead of schedule, potentially saving you thousands. And for those of you who are ready for an advanced strategy, I will lay out the blueprint for a system that can use your home's equity to pay off your entire mortgage in as little as 5 to 7 years. You thought saving $71,000 was impressive? We are just getting started. But before we dive into that high-octane equity shredding machine, we need to talk about a powerful tool that almost nobody knows about. It's a strategy so effective and so simple that I'm honestly shocked it's not more common. But when you understand how banks make their money, you'll see why they're not exactly advertising it on billboards. This is the single best option for anyone who comes into a lump sum of cash, maybe from an inheritance, a large work bonus, or the sale of another asset, and wants to immediately and permanently slash their monthly mortgage payment without the headache of refinancing. This strategy is called a mortgage recast, or sometimes a reamortization. Let's imagine a couple, we'll call them John and Sarah. They have a $400,000 mortgage at a 6% interest rate on a 30-year fixed loan. Their monthly principal and interest payment is about $2,398. They've been paying it for a few years and things are fine. But then they receive an unexpected inheritance of $100,000. Their first thought, the one almost everyone has, is to simply make a one-time lump sum payment of $100,000 directly to their mortgage principal. And that's a great idea, right? It knocks their loan balance down to $300,000 and will save them a fortune in interest over the life of the loan. But here's the problem, the one that trips everyone up. Their mandatory monthly payment of $2,398 doesn't change. Not by a single dollar. Yes, they'll pay off their loan much faster, but their month-to-month cash flow, the money they have to live on, remains exactly the same. They're still on the hook for that original payment amount every single month until the loan is paid off. For John and Sarah, who wanted to lower their monthly bills to free up cash for investments or college savings, this is a huge disappointment. They feel stuck. This is where the magic of a mortgage recast comes in. Instead of just sending in a check, they call their lender and say the magic words. "We want to request a mortgage recast." The lender, after probably being a little surprised they even know the term, walks them through a very simple process. John and Sarah make their $100,000 lump sum payment. Then, for a small administrative fee, usually just a few $100s, the bank does something beautiful. They reamortize the loan. They take the new lower principal balance of $300,000 and spread it out over the remaining term of their original loan at their original interest rate. Let's break that down. They still have their great 6% interest rate locked in. They still have the same loan payoff date, roughly 27 years away. But their monthly payment is now recalculated based on a balance that's $100,000 smaller. Let's do the math. Their new principal and interest payment would plummet from $2,398 down to approximately $1,833. That is a $565 reduction in their housing payment every single month. That's an extra $6,780 in their pockets every single year. Money they can now use to max out a Roth IRA, build up their emergency fund, or just breathe a little easier. They get the immediate relief on their monthly budget, and they still reap the rewards of paying less interest over the life of the loan. They get the best of both worlds. So why on earth is this not common knowledge? Why did their loan officer not mention this when they first got their mortgage? The answer is simple. Incentives. A mortgage recast is not a new loan. The bank isn't originating a new product. They can sell to investors on the secondary market. They're not charging thousands of dollars in closing costs and origination fees like they do with a refinance. For them, a recast is a low-profit administrative task. They're legally obligated to offer it if it's in your loan agreement, but they have absolutely no financial incentive to promote it. It's one of the best-kept secrets in the mortgage industry, hidden in plain sight. Now you might be thinking, okay, this sounds great, but what's the catch? There are a few things to know. First, not all loans are eligible. Generally, conventional conforming loans, the kind backed by Fannie Mae and Freddie Mac, are almost always eligible for a recast. However, government-backed loans like FHA and VA loans typically are not. You have to check with your specific lender. Second, there's usually a minimum amount for the lump sum payment. You can't just throw an extra $5,000 at it and ask for a recast. The minimum is often $10,000 or a certain percentage of your loan balance. And finally, as I mentioned, there's a small fee, typically between $150 and $500. But when you compare that to the thousands you'd pay in closing costs for a refinance, it's an absolute bargain. The action step here is incredibly simple. If you are expecting a lump sum of cash before you do anything, your first call should be to your mortgage servicer, the company you send your payment to each month. Don't just ask a general question. Use the specific terminology. Ask them, do you offer a mortgage recast or a reamortization, and what are the requirements? Get the details in writing. Find out the minimum payment, the fee, and the process. This one phone call could literally change your financial picture overnight, freeing up hundreds of dollars in your monthly budget without the pain, paperwork, and cost of a full refinance. It's a financial power move that puts you back in control. But let's be realistic. Most of us don't have a spare $100,000 sitting around waiting to be deployed. The recast is a perfect tool for a specific situation, but what about everyone else? What if your primary goal isn't just to lower your payment, but to take advantage of a massive drop in interest rates? What if your credit score has improved dramatically since you first bought your house, and you know you deserve a better deal? For that, we need to turn to the most well-known, yet most frequently misused tool in the homeowner's arsenal: the refinance. People think they understand refinancing, but the truth is, most people do it wrong. They focus on the wrong numbers, get taken in by clever marketing, and often end up in a worse position than where they started, sometimes without even realizing it. They trade one problem for another, resetting the clock on their debt and paying thousands in unnecessary fees. But there is a right way to do it. A strategic way. A way to not only slash your monthly payment, but to also dramatically reduce the total interest you pay, and even use the process to consolidate other, more toxic debts. It requires a shift in thinking, moving from a short-term "what's my payment?" mindset to a long-term wealth-building strategy. And in the next part, I'm going to show you exactly how to do it. I'll give you the checklist to determine if refinancing is right for you, expose the common traps lenders set for unsuspecting homeowners, and reveal the one key metric you must focus on to ensure you walk away a clear winner. Forget everything you think you know about refinancing. We're about to rebuild it from the ground up. So let's start with a simple, brutal truth about refinancing. It is not about getting a new loan. It's about replacing your old one. Think of it like a car. You don't take your 10-year-old sedan to the dealer to get a new paint job and some new tires. You trade the entire car in for a newer, better, more efficient model. Your mortgage is the same. Refinancing is the act of trading in your old, clunky, expensive financial engine for a sleek, modern one that saves you gas, or in this case, cash every single month. The old loan is paid off completely. It vanishes. In its place, a brand new loan is born with a new interest rate, a new monthly payment, and sometimes even a new loan amount. But why go through all this trouble? Why trade in the car at all? The reasons people refinance typically fall into four main categories, and understanding which one is yours is the first step to not getting ripped off. First, and most famously, is to get a lower interest rate. This is the holy grail. It's the reason you see all those ads online screaming rates have dropped. Act now. Let's make this real. Imagine you have a $400,000 mortgage with a 30-year fixed rate of 6.5%. Your monthly principal and interest payment is about $2,528. Now let's say the market shifts and you can refinance that same loan amount into a new 30-year loan at 5.5%. Your new monthly payment drops to $2,271. That's a savings of $257 every single month. That doesn't sound like a life-changing lottery win, right? But hold on. Over a year, that's over $3,000 back in your pocket. Over the first 5 years alone, that's more than $15,000. That's a new car, a dream vacation, a massive boost to your kids' college fund, all from a single financial maneuver. That is the raw power of a rate reduction. The second reason is to change the loan term. This is where you have to be careful, because it's a double-edged sword. Let's say you're 10 years into your 30-year mortgage. You're doing well financially, and you hate the idea of paying interest for another 20 years. You could refinance into a 15-year loan. Now, your monthly payment will almost certainly go up, maybe significantly, but the trade-off is staggering. You'll be debt-free a decade and a half sooner, and you will save an astronomical amount in interest over the life of the loan. We're talking potentially over $100,000 in savings. It's financial acceleration. On the flip side, some people need breathing room. They're struggling with the monthly payment. They might refinance their loan, which has 22 years left on it, back into a brand new 30-year loan. This will almost always lower their monthly payment, providing immediate financial relief. But, and this is a huge but, it resets the clock. You're now paying for 30 years all over again, which means you'll likely pay far more in total interest by the time you're done. It's trading long-term costs for short-term relief. Neither is inherently bad, but you have to know which game you're playing. Third, there's the cash-out refinance. This is where your home stops being just a place to live and starts acting like a bank account. Let's say your home is worth $500,000, and you only owe $250,000 on your mortgage. You have $250,000 in home equity. With a cash-out refi, you could take out a new, larger loan for, say, $300,000. The first $250,000 pays off your old mortgage, and the extra $50,000 lands in your bank account tax-free. People use this money for everything: to pay for a major kitchen renovation, to consolidate high-interest credit card debt, to pay for college tuition, or to start a business. It can be an incredibly powerful tool. It can also be incredibly dangerous if you use it to finance a lifestyle you can't afford, because you are turning your home's equity, your wealth, into debt that you have to pay back with interest. Finally, the fourth reason is to switch your loan type, most commonly from an adjustable rate mortgage or ARM to a stable, predictable fixed-rate mortgage. If you have an ARM, your interest rate can change over time. This is great when rates are falling, but it can be a nightmare when they're rising. Refinancing to a fixed rate is like getting off a financial roller coaster and onto a smooth, straight monorail. Your payment is the same every single month for the life of the loan. It's a move for peace of mind. So lower rate, change term, get cash out, or switch loan type. Those are the whys. But knowing why you want to refinance is useless if you fall into the biggest trap in the entire industry. This trap is built on a simple, dangerous myth. The myth that refinancing is free. Let me be crystal clear. There is no such thing as a free refinance. It costs money to create a mortgage. There are appraisal fees to verify your home's value, title insurance fees to ensure ownership is clear, lender origination fees for processing the loan, and a dozen other little costs that add up. These are called closing costs, and they typically range from 2 to 5% of the total loan amount. On a $400,000 loan, that could be anywhere from $8,000 to $20,000. So how do lenders advertise a no-cost refinance? It's a magic trick, a shell game. They make the costs disappear in one of two ways. The first way is to simply roll the closing costs into your new loan balance. So, if you're refinancing your $400,000 mortgage and the costs are $8,000, your new loan isn't for $400,000. It's for $408,000. You didn't pay cash out of pocket, but you are now paying interest on those costs for the next 30 years. The free loan just got very expensive. The second and even sneakier method is by giving you a higher interest rate. The lender might say, "Sure, we can give you a loan at 5.75% with zero closing costs." But what they don't tell you is that if you were willing to pay the closing costs, you could have qualified for a rate of 5.5%. That 0.25% difference seems tiny, but the lender is making a calculated bet. They pay the closing costs on your behalf, and in exchange, they collect that extra 0.25% of interest from you every single month for years and years. They always make their money back and then some. This brings us to the single most important number in any refinance decision. This is the metric I promised you, the one that cuts through all the marketing nonsense and tells you the mathematical truth. It's called the break-even point. The break-even point is the precise moment in time when your accumulated monthly savings from the refinance officially pay back your total closing costs. After this point, every dollar you save is pure profit. Before this point, you're still in the red. The formula is beautifully simple. Total closing costs divided by your monthly savings. That's it. Let's go back to our example. You're refinancing your $400,000 loan. Lender A offers you a no-cost refinance at 5.75%. Lender B offers you a 5.5% rate, but with $8,000 in closing costs. Your monthly savings with Lender B are $257. So, you take the $8,000 in closing costs and divide it by your $257 in monthly savings. The answer is 31.1. It will take you just over 31 months to break even. This number is your North Star. Tells you everything. If you know with absolute certainty that you are going to stay in that house for at least 32 months, about 2.5 years, then taking the loan with closing costs is a mathematical slam dunk. After that point, you are saving an extra $257 every single month compared to the no-cost option. But if you think there's a chance you might sell the house or move in the next 2 years, that no-cost refinance is actually the smarter choice. You won't save as much per month, but you also won't lose thousands of dollars in closing costs that you never had time to recoup. The break-even point transforms you from a consumer into an investor. It forces you to ask the most important question: how long am I going to be in this home? Without that answer, you're just guessing. Lenders love guessers. So now you know the fundamental rule. Calculate the break-even point. But this is just the key to the first lock. The next question is even bigger. How do you know when the market is right? How do you know when your personal finances are right? In the next part, we're going to dissect the win of refinancing. I'll show you the 3 critical signals, 2 from the market and 1 from your own wallet, that scream it's time to act. And I'll reveal the single biggest mistake people make before they even apply. A mistake that can get their application denied and tank their credit score. So let's start with those 3 critical signals. Think of them as green lights on the highway to a lower monthly payment. The first and most obvious signal is a significant drop in market interest rates. For years, the rule of thumb was to only consider refinancing if you could lower your rate by at least 1 to 2%. But frankly, in today's economy, that rule is obsolete. It's a relic from a time when closing costs were much higher and the process was clunkier. Today, with more competition and streamlined digital processes, even a smaller drop can put a lot of money back in your pocket. Let's do the math. Imagine you have a $300,000 mortgage at a 6.5% interest rate. Your monthly principal and interest payment is about $1,896. Now, let's say the market rates dip to 5.75%. That's a drop of only 0.75%, not the full 1% the old rule demands. But if you refinance at that new rate, your monthly payment drops to $1,751. That's $145 a month. Over a year, that's $1,740. That's a vacation. That's your car insurance paid for. That's a serious boost to your emergency fund. And over the life of the loan, the savings are staggering. So the new rule is this: if the current market rate is lower than your rate, it's time to run the numbers. Don't dismiss it just because it's not a 2% drop. The second signal is a surge in your home's value. And for millions of Americans, this has been the story of the last few years. Your neighborhood has boomed, and your house is suddenly worth far more than what you paid for it. This isn't just a nice number to see on Zillow. It's a powerful financial tool called equity. Equity is the part of your home you actually own, the difference between its market value and what you still owe on your mortgage. The more equity you have, the less risky you look to a lender. But here's the real magic. If you originally put down less than 20% when you bought your house, you are almost certainly paying something called private mortgage insurance or PMI. This is an extra fee tacked onto your mortgage payment every single month, and it does absolutely nothing for you. It only protects the lender in case you default. It can cost anywhere from $50 to over $200 a month, depending on your loan size and credit score. It's like throwing money into a bonfire. When you refinance with significant new equity, you can often eliminate PMI entirely. If your loan-to-value ratio, that's the amount you owe compared to the home's new higher value, is now below 80%, you can tell your lender to get rid of that PMI payment forever. This is, without a doubt, one of the fastest ways to slash your monthly housing cost. It's a direct savings that hits your bank account every single month. So if your home value has shot up, that's a massive green light. The third signal has nothing to do with the market and everything to do with you. It's a major improvement in your personal financial picture. This usually comes in two forms: a big jump in your credit score or a significant increase in your income. Maybe when you first bought your home, your credit was just okay, you were in the high 600s. But now, after years of responsible payments on your mortgage, car loans, and credit cards, your FICO score is shining bright in the high 700s or even 800s. That change is like getting a VIP pass at the bank. Lenders operate in tiers. A 680 credit score gets you one set of rates. A 760 score unlocks a completely different, much cheaper world of interest rates. You've proven you're a reliable borrower, and you deserve to be rewarded with a lower rate. You've earned it. Similarly, if you've gotten a big promotion, or your household income has increased substantially, your debt-to-income ratio has improved. This also makes you a much stronger candidate for the best possible terms. So if your personal finances are in a much better place than when you first signed those mortgage papers, that is your wallet personally telling you it's time to act. Now, for the single biggest mistake people make. It happens before they even get a single offer. It's a mistake born from fear and misinformation, and it costs people thousands by trapping them in a bad deal. The mistake is shopping for a mortgage rate the wrong way. Here's what most people do. They're scared of having their credit pulled. They've heard horror stories about how every hard inquiry dings your credit score. So they dip their toes in the water. They call up one lender, maybe the bank they have a checking account with, and they ask for a quote. They give some basic information, and the loan officer gives them a hypothetical rate. Or they go on a website, type in some numbers, and get a flashy advertised rate. They think they've done their research. This is a catastrophic error. Those quotes are meaningless. An advertised rate is a marketing gimmick, not an offer. A verbal quote from a loan officer is not binding. It's designed to get you hooked, to get you to commit to them before you see what else is out there. The fear of hurting their credit score by applying to multiple lenders paralyzes people. But here is the truth that the credit bureaus and lenders don't shout from the rooftops. The credit scoring models are smart. They know the difference between someone frantically applying for 10 different credit cards and someone prudently shopping for a single large loan, like a mortgage or a car loan. When you are rate shopping for a mortgage, all hard inquiries made within a specific time frame, typically 14 to 45 days depending on the scoring model, are treated as a single event. Let me repeat that. You can apply with one lender, 5 lenders, or 10 lenders within that window, and it will have the exact same impact on your credit score as applying with just one. It will be treated as one single inquiry. The system is built to allow you and encourage you to shop around for the best deal. So, the biggest mistake is not shopping around enough because of a myth. The correct way to do it is to go all in all at once. You don't date lenders one at a time. You create a competition for your business. Here's the battle plan. First, get your documents in order. That means your last 2 years of tax returns, 2 months of bank statements, recent pay stubs, and W-2s. Have them scanned and ready in a folder on your computer. Second, you choose 3 to 5 different lenders to apply to. This should be a mix. Maybe one big national bank, one local credit union, and a couple of highly rated online lenders. Third, and this is the most important step, you submit all of your applications in a compressed time frame. Do it on the same day. A Monday morning is perfect. Fire off all your applications within a couple of hours. By doing this, you trigger the shopping window and protect your credit score. But more importantly, you force these lenders to compete for your business in real time. Within 1 to 3 days, each of them is required by federal law to send you an official standardized document. It's called the loan estimate. This 3-page document is your ultimate weapon. It's not a marketing flyer or a verbal promise. It is a legally binding breakdown of the loan they are offering you. It shows you the interest rate, the monthly payment, and crucially all the closing costs and fees line by line. Everything is laid out in the same format, no matter which lender it comes from, making it incredibly easy to compare your offers apples to apples. You're no longer comparing a vague promise from lender A to a flashy ad from lender B. You're comparing official, legally binding documents. This is how you find the true best deal, not just the one with the lowest sounding interest rate. But even with the loan estimate in hand, lenders have ways of hiding fees in plain sight. In the next part, we're going to dissect this document line by line. I'll show you the 3 most common junk fees you can and should negotiate away, and how to spot a classic bait-and-switch offer before it ends up costing you thousands of dollars at the closing table. So let's do it. Grab a copy of your loan estimate. If you don't have one yet because you're just starting the process, that's even better. You're about to be 10 steps ahead of everyone else. This document, this 3-page PDF, is your roadmap. It's the battle plan. Before 2015, lenders could give you a vague good faith estimate that was often wildly different from the final numbers. But after the housing crisis, the government stepped in and created this standardized form. The beauty of it is that every lender, from the biggest bank in New York to the smallest credit union in your hometown, has to use the exact same document. This means you can compare offers apples to apples, and that, my friends, is your superpower. Okay, eyes on page 2. We're looking at the closing cost details. This is where the magic and the mischief happens. You'll see a bunch of sections, A, B, C, and so on. We're starting with the most important one. Section A, origination charges. Think of this as the lender's direct profit. This is what they are charging you for the service of creating your loan. It's also where they hide the fees they hope you won't notice. The very first line, item 01, is usually points. This is a percentage of the loan amount you pay up front to get a lower interest rate. We'll dive deep into whether paying for points is a smart financial move in a later part of this series. But for now, just know that this number is a direct result of the interest rate you were quoted. The real negotiation battleground is right below it. You're looking for 3 specific culprits. I call them the big 3 of junk fees: the application fee, the underwriting fee, and the processing fee. Sometimes they have slightly different names, like an admin fee or a loan origination fee. But the principle is the same. These are charges for the basic administrative work of putting your loan together. Let's start with the application fee. Some lenders charge this, some don't. In my opinion, you should never pay it. You are the customer bringing them tens or hundreds of thousands of dollars in business over the next 30 years. Charging you a fee just to apply is like a restaurant charging you a fee to look at the menu. It's ridiculous. If you see an application fee on your loan estimate, your first question should be, can you waive this? More often than not, they will, because they know it's a weak charge. Next, the underwriting fee and the processing fee. This is the big one. Underwriting is the process of the lender verifying your financial information and approving you for the loan. Processing is the act of gathering all your documents and putting the file together. Now, are these real costs for the lender? Yes, they have to pay underwriters and processors. But here's the secret. The cost of doing that work is already baked into the interest rate they're offering you. The interest rate is their profit margin. Charging you a separate, explicit fee for underwriting and processing is like going to a restaurant, ordering a steak for $50, and then getting a bill that also includes a separate $20 cooking fee. It's double dipping. Lenders get away with this because it has become standard practice, and most people just assume it's a mandatory, non-negotiable cost of getting a mortgage. It is not. These fees are pure profit centers, and they are highly negotiable. You might see an underwriting fee of $800, a processing fee of $500. That's $1,300 right there that you can potentially get wiped away. So how do you do it? You don't call them up angry. You don't accuse them of ripping you off. You approach it from a position of power. And your power comes from having a competing offer. This is why you must shop around and apply with at least 3 different lenders. Once you have multiple loan estimates, you pick the one with the best combination of rate and fees. Then you call the other lenders. The script is simple. You say, "Hi, I'm looking at your loan estimate and comparing it with another offer I've received. I'd really prefer to work with you, but your competitor isn't charging an underwriting fee or a processing fee. Are you able to match that?" That's it. You're not demanding, you're inquiring. You're not being confrontational. You're being a savvy consumer. You're making it clear that you know these fees are negotiable and that you have other options. 9 times out of 10, they will either remove the fees entirely or significantly reduce them to keep your business. They would rather make a little less profit from you than make zero profit from you. Now let's talk about that bait and switch I mentioned. This is where Section A becomes your lie detector. The classic bait and switch goes like this. You talk to a loan officer on the phone, and they quote you an incredible deal. We can get you a 6.5% rate with no lender fees. It sounds amazing, the best deal you've heard. You get excited, you submit your application, you pay for the appraisal. Then, a few days later, you get the official loan estimate, and you look at Section A. Suddenly, there's a $1,500 origination fee, or a $1,200 admin fee. When you call them on it, they'll say, "Oh, well, that's not a lender fee, that's a standard origination charge." It's a game of semantics. They lured you in with a promise that wasn't technically a lie, but was absolutely misleading. They're banking on the fact that you've already invested time and money, you've paid for the appraisal, and that you'll just sigh and accept the new higher costs rather than starting the whole process over. Don't fall for it. The moment you see a significant fee in Section A that wasn't disclosed up front, it's a massive red flag. Your response should be to immediately forward that loan estimate to the other lenders you spoke with and say, "Can you beat this?" Use their bad behavior to your advantage. Now let's look at the next section on your loan estimate. Section B. Services you cannot shop for. This is a tricky one. These are third-party services that the lender chooses on your behalf. The most common ones are the appraisal fee, the credit report fee, and the flood certification fee. Because you can't choose your own appraiser or credit reporting agency, your ability to negotiate these costs is limited. But that doesn't mean you have zero control. The lender is required to give you a good faith estimate of these costs. However, sometimes they'll pad them. They might estimate an appraisal will cost $750 when the actual cost from the appraiser they hire is only $600. The extra $150 goes right into their pocket. The way to protect yourself here is to ask for a copy of the actual invoice from the third-party provider. For the appraisal, you are legally entitled to a copy of the report, and you can ask for the invoice that came with it. If the invoice shows a charge of $600, but the lender has $750 on your closing statement, you have every right to challenge that discrepancy. It's a simple question. Can you please provide the invoice for this charge? I'd just like to confirm the cost matches what I'm being charged. This keeps them honest. You're not accusing them of anything. You're just verifying. So to recap what we've just covered, Section A is your primary negotiation battleground. You challenge the application fee, and you use competing offers to eliminate or drastically reduce underwriting and processing fees. You use Section A as a lie detector to spot any bait-and-switch tactics between a verbal quote and the written loan estimate. For Section B, while you can't shop for these services, you can and should demand to see the receipts, ensuring you're only paying the true third-party cost, not a padded, inflated number. By mastering just these 2 sections, you're already putting yourself in a position to save $1,000, $2,000, maybe even $3,000 in closing costs. That's real money that stays in your pocket. Money you can use for moving expenses, new furniture, or just to beef up your emergency fund. This isn't about being cheap. It's about being smart. You're making the single largest purchase of your life, and you have a right to ensure you're not paying a single dollar more than you have to. But we're not done. In fact, the next section we're going to break down is where the biggest, most overlooked savings are hiding. I'm talking about Section C, services you can shop for. This is where things like title insurance and settlement services live. Most homebuyers just go with the company the lender or the real estate agent recommends, not realizing that this recommendation could be costing them thousands of dollars. It's a hidden world of kickbacks and convenience charges, and I'm going to show you exactly how to navigate it, how to shop for these services like a pro, and why spending just 1 hour doing this can save you more money than almost any other tip in this entire series. That hidden world I was talking about? It's your homeowner's insurance. And the reason it's a minefield of overcharges is because of one simple fact. When you were closing on your house, you were overwhelmed. You were signing a mountain of paperwork, you were stressed about the move, and your lender said, "Hey, we have a preferred insurance partner. We can roll it all in, make it easy for you." And you, like millions of others, said, "Yes, please just make it stop." What you didn't realize is that preferred partner is often code for the company that has a cozy relationship with your lender. It's not necessarily the cheapest. It's not necessarily the best. It's just the easiest. And that convenience is costing you. We're not talking about a few dollars here and there. We're talking about the potential for hundreds, even over $1,000 every single year, baked right into your monthly mortgage payment. For 30 years. The math on that is staggering. This isn't some fringe issue. A 2021 study showed that nearly 40% of homeowners have never shopped for a new insurance policy after their initial purchase. They set it and forget it, assuming the rate they got at closing was competitive. It's a loyalty tax and you're the one paying it. Your lender's job was to make sure the house was insured, so their asset was protected. Their job was not to find you the best deal. That's your job. And today, I'm giving you the playbook to do it. First, you need to understand what you're actually paying for. Find your current homeowner's insurance policy. You're looking for a document called the declarations page. It's the one-page summary of everything. If you can't find it, call your insurance company and ask them to email it to you. This is your treasure map. It shows your coverage amounts, your deductible, and most importantly, your annual premium. This premium divided by 12 is what's being added to your mortgage payment every month through your escrow account. Now let's decode this map. You're going to see a few key terms. Don't let them intimidate you. First is dwelling coverage. This is the big one. It's the amount it would cost to completely rebuild your house from the ground up if it were destroyed. This is not the market value of your home. It's the replacement cost. A critical distinction. You want this number to be accurate. Too low and you're underinsured. Too high and you're paying for coverage you don't need. Next, personal property. This covers your stuff, your furniture, your electronics, your clothes. It's usually calculated as a percentage of your dwelling coverage, often between 50 and 70%. Then there's liability. This is your financial protection if someone gets injured on your property and decides to sue you. In today's world, you do not want to skimp on this. Most policies start at $100,000, but upgrading to $300,000 or $500,000 often costs very little and buys you an immense amount of peace of mind. Finally, you'll see your deductible. This is the amount of money you have to pay out of pocket on a claim before the insurance company pays a dime. A higher deductible means a lower monthly premium. We're going to come back to this because it's one of the most powerful levers you can pull to save money. Okay, you have your declarations page. You understand the basics. Now the hunt begins. It's time to shop. You have 3 primary ways to do this. Option 1 is the traditional route. Call an independent insurance agent. These are not people who work for one company like State Farm or Allstate. They are brokers who work with dozens of different insurance companies. Their job is to take your information and shop it around to all of them to find you the best combination of coverage and price. This is a fantastic option if you want a human to guide you through the process. The best part? It doesn't cost you anything. They get paid a commission by the insurance company they place you with. Option 2 is to go direct. This means you pick up the phone or go to the websites of the big carriers yourself, companies like Geico, Progressive, or Liberty Mutual. You enter your information directly into their system and get a quote. This can be effective if you already have a company in mind, but it's time-consuming. You have to re-enter your information over and over again on each different site. Option 3 is the modern hybrid. Use an online insurance marketplace. Websites like Policy Genius or the Zebra are essentially digital independent agents. You fill out one long form, and their technology instantly compares quotes from numerous carriers for you, laying them all out on the screen. This is often the fastest and most efficient way to get a broad view of the market. My recommendation? Do at least 2 of these 3. Call one highly rated local independent agent and use one online marketplace. This way you get the best of both worlds, human expertise and technological efficiency, and you ensure no stone is left unturned. When you get these new quotes, do not just look at the price. This is the biggest mistake people make. You must compare them apples to apples with your current policy. Pull out that declarations page again. Make sure the dwelling coverage is the same. Make sure the liability limits are the same. Make sure the personal property coverage is the same. Only when the coverages match can you truly compare the price. You'll likely be shocked. It's not uncommon to find identical coverage for $50, $80, even $100 less per month. That's $1,000 a year back in your pocket. But we're not done. Now it's time for the pro-level strategies. Once you've found a few companies that are significantly cheaper for the same coverage, it's time to optimize. First, ask about bundling. If you have your auto insurance with one company and your home insurance with another, you're leaving a massive discount on the table. The bundle discount or multi-policy discount. is often one of the biggest they offer, sometimes as much as 25%. Always get a quote for both your home and auto insurance together. Even if your auto insurance goes up by a tiny amount, the savings on your home insurance will often dwarf that, leading to a huge net savings overall. Second, let's talk about that deductible. Your current policy might have a $500 or $1,000 deductible. Ask your agent or look on the quote tool. What happens to the premium if you raise that deductible to $2,000 or $2,500? The savings can be substantial. The logic here is simple. You shouldn't be using your homeowner's insurance for small claims anyway. It's for catastrophes. By agreeing to cover a slightly larger amount yourself in a worst-case scenario, you can save hundreds of dollars in guaranteed premium savings, year after year. Third, dig for hidden discounts. You have to ask for them. Did you install a Ring doorbell or a security system? That's a discount. Do you have smoke detectors and fire extinguishers? That's a discount. Have you been claim-free for several years? Discount. Is your roof less than 10 years old? That can be a huge discount. Many insurers see a new roof as a major mitigator of risk. Go down the list and make sure you're getting credit for every single safety feature in your home. Once you've chosen your new, cheaper, better policy, the final step is easy. You sign the new policy, and then you call your mortgage servicer, the company you send your payment to every month. You tell them you've switched insurance providers, and give them the new policy information. They will handle the rest, adjusting your escrow payment to reflect the new, lower premium. Your very next mortgage bill will be smaller. It's that simple. 1 hour. That's all this takes. 1 hour of focused effort to gather your documents, make a few calls, and compare your options can permanently lower your single biggest monthly expense. You are not being disloyal to your old insurance company. This isn't personal, it's business. It's your money. By systematically eliminating these convenience fees and loyalty taxes, we are chipping away at that bloated mortgage payment. But homeowners insurance, as costly as it can be, isn't the only insurance you might be forced to pay through your mortgage. There's another, more insidious type of insurance that millions of homeowners are paying for every single month. It offers you, the homeowner, absolutely zero protection, yet it can cost hundreds of dollars. It's called private mortgage insurance, or PMI. And in our next part, I'm going to show you how to get rid of it, potentially slashing your monthly bill overnight. So how do we fire this unwanted employee that you're forced to pay every single month? How do we get rid of private mortgage insurance and reclaim that money for ourselves? First, we have to understand the battlefield. PMI exists for one reason: to protect the lender, not you. When you put down less than 20% on a conventional loan, the bank sees you as a higher risk. If you default, they stand to lose more money. So, they force you to buy an insurance policy that pays them if you stop paying. It's like being forced to pay for a security guard that only protects the store, not the customers. You get zero benefit, but you're footing the entire bill. The key to canceling this one-sided contract is something called the loan-to-value ratio, or LTV. It's simple. It's the amount you owe on your mortgage divided by the home's current market value. If you owe $250,000 on a home that's worth $500,000, your LTV is 50%. The magic number, the one that unlocks the door to getting rid of PMI, is 80%. Once your loan balance drops to 80% of your home's original value, you have the right to request that your lender cancel PMI. But here's something most people don't know. There are two different paths to this freedom, and one is much, much faster than the other. The first path is the slow, automatic, legally mandated one. It's based on a federal law called the Homeowners Protection Act. This law states that your mortgage servicer must automatically terminate PMI when your loan balance is scheduled to reach 78% of the original value of your home. Original value is key here. That's the price you paid for the house, or the appraised value at the time of purchase, whichever was lower. So, on a $400,000 home, once your loan balance drops to $312,000, the PMI should, in theory, just disappear. This is the do-nothing option. You just keep making your regular payments, and eventually, years down the line, it goes away. But who wants to wait? That's like waiting for a prison sentence to end when you have the key to the cell in your pocket. You are overpaying every single month you wait. That's where the second, proactive path comes in. This is how you take control. The same law gives you the right to request PMI cancellation once your loan balance hits 80% of the original value. That's a 2% difference from the automatic 78%, which can translate to many months, even years of payments. On that same $400,000 home, you can request cancellation when your balance hits $320,000, not $312,000. Why would you voluntarily pay an extra $100 or $200 a month for a year if you didn't have to? So here's the exact playbook. Once you believe you've hit that 80% LTV mark based on your original purchase price, you pick up the phone. You call your mortgage servicer, the company you send your check to every month, and you tell them you want to initiate the process to remove your private mortgage insurance. They can't just say no. They will, however, have a checklist. First, your request has to be in writing. Second, you must have a good payment history. A late payment in the last year can be a deal breaker. Third, they'll want to make sure you don't have any other loans against the property, like a home equity line of credit, which would change the risk profile. If you check these boxes, they are legally obligated to cancel it. That one phone call, that one letter, could save you thousands of dollars over the next few years. But this is where the story gets really interesting. We've only been talking about the original value of your home. What if your home is now worth way more than what you paid for it? We've seen insane appreciation across the country in the last several years. This is the ultimate cheat code for killing PMI. And it's the one most homeowners completely overlook. Let's go back to our example. You bought a home for $400,000 with 5% down. Your loan was for $380,000. To get to that 80% LTV, you'd need to pay your loan down to $320,000, a $60,000 mountain of principal you have to chip away at month by month, year by year. But let's say you bought that home 3 years ago. The housing market in your neighborhood went crazy. Your neighbor just sold an identical house for $500,000. Your home isn't worth $400,000 anymore. It's worth $500,000. Now let's rerun the numbers with this new reality. What's 80% of the new value of $500,000? It's $400,000. Your current loan balance might be, say, $365,000 after a few years of payments. Suddenly, you don't have a 91% LTV anymore. Your new LTV is your $365,000 loan, divided by your new $500,000 value. That's a 73% LTV. You are not just at the 80% threshold, you've blown past it. You are deep into the territory where PMI should not exist. So how do you prove it? You can't just call your lender and say, "Hey, Zillow says my house is worth more now." They need proof. This is where you have to make a small investment to save a fortune. You have to pay for a new appraisal. You'll contact your lender and tell them you want to remove PMI based on the current market value of your property. They will order an appraisal from one of their approved professionals. This might cost you anywhere from $400 to $700. But if your monthly PMI is $150, you make that money back in just a few months, and then it's pure savings from there on out. The appraiser comes to your home, evaluates its condition, looks at recent comparable sales in your area, what we call comps, and determines its current fair market value. If that appraisal comes in high enough to drop your LTV to 80% or below, congratulations. You've just fast-forwarded your finances by years. There is a small risk, of course. If the appraisal comes in lower than you expect, you've spent that money for nothing. So before you pull the trigger, do your own homework. Look up recent sales of similar homes in your zip code. Be realistic about the condition of your home compared to others. And this leads to another powerful strategy: you can force the appreciation yourself. Have you done any major home improvements? Did you finish the basement? Remodel the kitchen? Add a bathroom? These aren't just lifestyle upgrades. They are strategic financial moves that build equity and increase your home's value. A dated kitchen can hold a home's value down. A brand new one with modern appliances and granite countertops can add tens of thousands of dollars to an appraisal. When you request the new appraisal, make sure you provide the appraiser with a detailed list of all the upgrades you've made, including the cost and the date they were completed. You built that value. Now it's time to cash in on it by using it to eliminate your PMI payment. So to recap the battle plan against this financial dead weight. First, track your loan balance against the original 80% LTV threshold and request its removal the second you hit it. Don't wait for the bank to do it for you at 78%. Second, and more powerfully, keep a close eye on your local housing market. If values are rising, you are likely closer to removing PMI than you think. Invest in an appraisal to prove it. And third, if you're making improvements, understand that you're not just building a better home. You're building a case to lower your monthly mortgage bill. Getting rid of PMI is one of the single biggest and fastest ways to reduce your monthly payment. It's a fee that provides you, the homeowner, absolutely zero value, and eliminating it feels like giving yourself an instant raise. But once you've successfully slayed the PMI dragon, you might look at your new lower monthly statement and think, "That's great, But can I do better? What if I told you there's a way to lower your payment even more without the cost, the paperwork, and the credit check of a full refinance? It's a little-known banking maneuver that can slash your monthly payment by hundreds of dollars, and it's called a mortgage recast. And that is exactly what we're breaking down next. So, what on earth is a mortgage recast? Think of it like this: your mortgage is a giant pizza. When you first bought it, it had 360 slices, one for each month of your 30-year loan. A refinance is like throwing that whole pizza away and ordering a brand new one with a different price, different toppings, maybe even a different size. But a recast? A recast is like walking up to the pizza you already have, taking a huge handful of slices off the end, and throwing them away. You still have the same pizza with the same delicious toppings, your amazing low interest rate, but now the remaining slices are redivided among the same number of people, meaning everyone's portion, your monthly payment, gets smaller. That's it. You make a large lump sum payment towards your principal balance, and then you ask your lender to re-amortize the new lower balance over the remaining term of your loan. Your interest rate doesn't change. Your loan's end date doesn't change. The only thing that changes is that your monthly payment goes down, often dramatically. It's the banking world's best-kept secret for homeowners who locked in those incredible sub-3 or sub-4% interest rates a few years ago. For them, refinancing would be financial insanity. Why would you trade a 2.9% rate for a 7% rate? You wouldn't. But with a recast, you get the benefit of a lower payment without sacrificing your golden ticket interest rate. So who is this for? This isn't for everyone, and that's a critical point. A recast is for a specific type of homeowner. It's for you if you've recently come into a significant amount of cash. Maybe you received a large work bonus. Maybe you inherited some money. Perhaps you sold another property, or your stock options finally vested. If you have a lump sum, we're typically talking at least $10,000, but often more. And you're wondering what the smartest thing to do with it is, recasting needs to be on your radar. Let's walk through a real-world example to make this crystal clear. Meet Alex. 3 years ago, Alex bought a house with a $500,000 mortgage on a 30-year term, and he was lucky enough to lock in a 3% interest rate. His monthly principal and interest payment is about $2,108. Now fast forward to today. Alex just sold some company stock and has a $100,000 windfall. His emergency fund is full, his high-interest debt is gone, and he's trying to decide what to do with this cash. He could refinance, but rates are now at 7%. That would be a catastrophic move, sending his payments soaring. But Alex is smart. He calls his lender and asks about a mortgage recast. He confirms he's eligible, and that the minimum lump sum payment is $20,000. His $100,000 is more than enough. So, he sends the $100,000 to his lender, specifically designated to go towards his principal balance. His original $500,000 loan is now, roughly, a $385,000 loan, after accounting for the principal he's already paid over 3 years. Now the magic happens. The bank takes this new lower balance of $385,000 and recalculates his payment. But here's the key. They spread it over the remaining term of his loan. He had 30 years or 360 months. He's paid for 3 years or 36 months. So he has 27 years, or 324 months, left. His amazing 3% interest rate stays exactly the same. The bank does the math and Alex gets a letter in the mail. His new monthly principal and interest payment is no longer $2,108. It's now $1,623. Let that sink in. By making one single move, Alex just freed up $485 in cash flow. Every single month. That's nearly $6,000 a year. That's a family vacation. That's maxing out a Roth IRA. That's a massive car payment gone. He accomplished the primary goal of a refinance, a lower monthly payment, but he did it for a fraction of the cost, a fraction of the hassle, and most importantly, he got to keep his once-in-a-generation 3% interest rate. The advantages are huge. First and foremost, you keep your low interest rate, which in today's market is the single biggest financial advantage a homeowner can have. Second, the cost is minimal. A full refinance can cost thousands, sometimes tens of thousands of dollars in closing costs. A recast typically costs just a few $100s in administrative fees. We're talking maybe $250 to $500. Third, the process is incredibly simple. There's no new credit check, no new appraisal, no mountain of income verification paperwork. It's usually just one form and a phone call. You're dealing with your existing lender, so it's a simple modification, not a whole new loan application. But, and this is a very important but, it's not a perfect solution for everyone. There are some serious caveats you need to understand. First, not all loans are eligible. Most conventional loans are, but government-backed loans like FHA, VA, and USDA loans typically do not allow recasting. You have to check with your specific lender. Also, some lenders have rules like you can't have made a late payment in the last 12 months, or you have to have a certain amount of equity in your home. Second, and most obviously, you need a big chunk of cash. The minimum amount can vary, but it's often 10% of your remaining balance or a fixed number like $10,000 or $20,000. For many people, coming up with that kind of cash just isn't realistic. Third, and this is the big financial strategy question, is this the best use of your money? By putting that $100,000 into his mortgage, Alex is getting a guaranteed 3% return on his money, because that's the interest he's no longer paying on that principal. A guaranteed, risk-free 3% return is not bad. But could he have taken that same $100,000 and invested it in the stock market, which historically averages around 10% per year? Yes. Over the long run, he might have made more money by investing. This is the classic pay down the mortgage versus invest debate. Recasting is for people who prioritize cash flow and want a guaranteed risk-free return. If you're more aggressive and comfortable with market risk, you might choose to invest that lump sum instead. There's no single right answer. It's about your personal financial goals and risk tolerance. Finally, a recast does not shorten your loan term. Alex will still be making payments for the next 27 years. He's just making smaller payments. If your goal is to be debt-free as fast as possible, simply making that same $100,000 payment directly to your principal and not recasting is the better option. Your monthly payment would stay the same, but a much larger portion would go to principal each month, and you'd shave years, maybe even a decade, off your loan. Recasting is about improving monthly cash flow. Paying down principal without a recast is about becoming debt-free sooner. So, if you've weighed the pros and cons, you have the cash and you want to move forward, how do you actually do it? Surprisingly simple. Step 1. Call the customer service number for your mortgage servicer. That's the company you send your payment to each month, and simply ask, do you offer mortgage recasting or reamortization? Step 2. If they say yes, ask about their specific requirements. What's the minimum lump sum payment? What are the fees? Are there any forms I need to fill out? Get all the details in writing if you can. Step 3. Make the payment. This is crucial. You must specify that the entire lump sum is to be applied directly to the principal balance of the loan. Do not just send a big check. You need to be explicit in your instructions. Step 4. Once the payment has cleared, you'll complete the recast paperwork. It's usually a simple 1 or 2-page agreement. You sign it, send it back with the processing fee, and within a month or two, you'll receive a notification of your new, lower monthly payment. It's a powerful tool that most people have never even heard of. It's a way to get the best of both worlds: the security of a lower payment and the incredible advantage of a locked-in low rate. But what if you don't have a giant pile of cash sitting around? What if a $20,000 lump sum payment sounds like a fantasy? Does that mean you're just stuck with your current payment forever? Absolutely not. There's another way to lower your pity, your principal, interest, taxes, and insurance, that requires no windfall, no bonus, and no inheritance. It's a way to lower your payment by challenging a number you probably think is set in stone. A number that gets mailed to you every year, causing you to sigh and just accept it as fact. Your property tax assessment. And in the next part, I'm going to show you exactly how to fight it and win. This isn't a bill. It's an opinion. Let me say that again. Your property tax assessment is not a fact carved in stone. It's the government's opinion of what your house is worth. And opinions can be wrong. In fact, they are wrong all the time. And you, the homeowner, have the absolute right to challenge that opinion. This isn't some secret loophole. It's a fundamental part of the system designed to protect you. Most people just don't know it exists, or they assume it's a complicated, expensive legal battle reserved for corporate lawyers. It's not. It's a process you can absolutely do yourself, and the savings aren't a one-time thing. A successful appeal lowers your property tax bill this year, next year, and every year after until the next big reassessment. The savings can stack up to thousands, even tens of thousands of dollars over the life of your loan. So how do you do it? First, you have to understand why their opinion is so often flawed. Your local tax assessor has a monumental task. They have to value every single piece of property in your county. They don't have time to walk through your house. They don't know you have a leaky roof or that your kitchen is straight out of 1982. They use what's called a mass appraisal system. It's basically a giant computer algorithm. It looks at general data, recent sales in your neighborhood, building permits, square footage records. It lumps your house in with everyone else's and spits out a number. It's efficient for them, but it's incredibly impersonal and prone to error. The algorithm doesn't know that the house down the street that sold for a fortune had a brand new $30,000 kitchen renovation and a finished basement with a home theater. It just sees a sale price and thinks, hey, all the houses on this street must be worth more now. And just like that, your assessment and your tax bill goes up based on a reality that has nothing to do with your actual home. Your job is to be the human element, to present the facts the computer model missed. The first step is to grab the assessment notice that came in the mail. Look past the scary-looking total and find 3 key pieces of information: the assessed value of your property, the deadline for filing an appeal, and the instructions on how to do it. That deadline is everything. Mark it on your calendar in bright red ink. If you miss it, you have to wait an entire year to try again, which means another year of overpaying. Once you have that notice, your real work begins. Your first mission is to find simple factual errors. You need to get a copy of your property record card from the assessor's office. This is usually available online through the county's website. This card is the blueprint they use to calculate your value. It lists everything they think they know about your house: square footage, number of bedrooms, number of bathrooms, age, construction materials, extra features like a fireplace or a deck. Go through this document line by line with a fine-tooth comb. Are there any mistakes? I have a friend who did this and discovered the county had his condo listed as having a 2-car garage. A 2-car garage in a high-rise condo building. It was a simple data entry error. But that non-existent garage was adding thousands to his assessed value and hundreds to his annual tax bill. He made one phone call, pointed out the error, and they fixed it on the spot. It was the easiest money he ever saved. Look for anything. Do they have your square footage wrong? Do they think you have a finished basement when it's just a concrete slab with a washing machine? Do they list 4 bathrooms when you only have 2.5? Any factual error is your golden ticket. It's the fastest and most undeniable way to win an appeal. But what if the facts on the card are correct? Don't worry. This is where most people win. You're now going to build a case that their valuation, their opinion of the price, is wrong. Your most powerful weapon here is what are known as comparable sales, or comps. You need to become a real estate detective. You're looking for evidence that houses similar to yours, in your immediate area, have recently sold for less than what the government claims your house is worth. Go to websites like Zillow or Redfin. Use their search filters to find recently sold homes. You want to look for sales that occur just before the official assessment date on your notice. That date is critical. A sale that happened after the assessment date is usually not considered valid evidence. Now filter for homes that are as similar to yours as possible. Same number of bedrooms and bathrooms. Similar square footage within about 10%. Similar lot size. Similar age. You want to create an apples-to-apples comparison. You're looking for at least 3 to 5 solid comps that sold for less than your assessed value. Let's say the county thinks your house is worth $400,000. But you find 3 nearly identical houses on the next street over that sold for $360,000, $370,000, and $375,000. That is powerful, undeniable evidence that your assessment is inflated. Print out the listings for these properties. Highlight the sale prices and the closing dates. Simultaneously, you need to document the reality of your own home. The assessor's computer assumes your house is in average or good condition. You need to prove otherwise. Get out your phone and take pictures of everything that's wrong with your property. That crack in the driveway? Snap a photo. The water stain on the ceiling from that old leak? Photo. The peeling paint on the exterior trim? Photo. Your outdated kitchen appliances from the turn of the century? Photo. The worn-out carpet, the single-pane windows, the fence that's falling over. Document it all. You are building a visual case that your home is not in the pristine condition the tax man assumes it is. If you have a major issue like a foundation problem or a roof that needs to be replaced, get a written estimate from a licensed contractor. An official estimate for a $15,000 roof replacement is a rock-solid piece of evidence that your home's value is diminished by at least that much. For bigger cases, you could even consider hiring a private appraiser. It might cost a few $100s, but a professional appraisal that comes in lower than the county's assessment can often win your case outright. Now you have your evidence file. The factual errors from the property card, the list of lower-priced comparable sales, and the photos and estimates of your home's flaws. It's time to make contact. Most places have a two-step process. First is an informal review. You'll call or schedule a meeting with someone from the assessor's office. Don't go in angry or accusatory. Be calm, polite, and professional. You're not there to fight. You're there to provide new information to help them correct their records. Lay out your evidence clearly. My property is assessed at $400,000. However, here are 3 very similar homes that recently sold for an average of $370,000. Additionally, my property record card incorrectly lists a finished basement, and as these photos show, the roof requires a complete replacement. In many cases, the assessor will review your evidence and make an adjustment right then and there. They want their records to be accurate, and they'd rather avoid a formal hearing if possible. If they don't budge, you move to step 2, the formal appeal. This usually involves presenting your case to a local appeal board, often made up of a few of your fellow citizens. This is not a courtroom. There are no lawyers in powdered wigs. It's a simple administrative hearing. You'll present your evidence just as you did in the informal review. Give each board member a copy of your packet. Speak clearly, stick to the facts, and state exactly what you think your property's value should be. Based on these comparable sales and the condition of the home, I believe a fair assessed value would be $370,000. Then you just let the evidence speak for itself. Winning an appeal like this is one of the most direct ways to slash your monthly housing cost, and the money you save is yours to keep year after year. It's a direct attack on the tea and pity, the part of your payment most people feel powerless to change. But this is just one piece of the puzzle. There is one final, often overlooked component of your mortgage payment that your lender has a vested interest in you never questioning. It's a number they calculate for you, a number they manage in an account you don't control, and a number that can be wildly inaccurate, costing you hundreds of dollars every month without you ever realizing it. We're talking about your escrow account. And in the final part of this series, we're going to pull back the curtain on how it really works and how to perform an audit that could put a significant chunk of cash right back in your pocket. So what exactly is this escrow account, and why does it feel like a black box for so many homeowners? Let's demystify it right now. Think of your escrow account as a separate savings account managed by your mortgage lender. Every month when you make your mortgage payment, a portion of it, the P and I for principal and interest, goes toward paying down your loan. But the other part, the T and I for taxes and insurance, gets diverted into this escrow account. Your lender then uses the money in that account to pay your property tax bills and your homeowner's insurance premiums on your behalf when they come due. Why do they do this? It's all about protecting their investment, your house. If you fail to pay your property taxes, the county can put a lien on your property and even foreclose, putting them ahead of the mortgage lender in line to get paid. If your house burns down and you don't have insurance, the lender's collateral literally goes up in smoke. So, by managing these payments for you, they ensure these critical bills are always paid on time, protecting their asset. Now, here's where the opportunity for you comes in. How does the lender decide how much to collect for escrow each month? They estimate your total annual property tax bill and your total annual homeowner's insurance premium. They add those two numbers together, divide by 12, and that's the monthly escrow payment. Simple enough, right? But there's a crucial detail. Federal law, specifically the Real Estate Settlement Procedures Act or RESPA, allows them to keep a cushion in your escrow account. This cushion is meant to cover unexpected increases in your tax or insurance bills. The law states this cushion cannot exceed 2 months' worth of your escrow payments. So, at its lowest point in the year, your escrow account can still have an amount equal to 2 months of payments sitting in it. The problem is, these are all based on estimates. And very often, these estimates are wrong, leading to what's called an escrow overage. Your lender might be holding hundreds or even thousands of your dollars hostage and you wouldn't even know it. This happens for a few common reasons. First, when you initially get your loan, the lender often pads the estimates to be safe, starting you off with an overpayment from day one. Second, your costs might have gone down. Remember in the last part when we talked about shopping for homeowners insurance? If you found a cheaper policy and saved $500 a year, but you didn't explicitly tell your mortgage servicer, they'll keep collecting the old, higher amount until their annual analysis catches it. The same goes for your property taxes. If you successfully appealed your property assessment and lowered your tax bill, the lender will continue to collect the higher amount until they are notified or do their analysis. This brings us to the escrow audit. This isn't some complicated forensic accounting. It's simple arithmetic that you can do in 10 minutes, and it could reveal a significant overpayment. Here's your step-by-step guide. First, gather your documents. You need 3 things: your most recent mortgage statement, your most recent property tax bill from your city or county, and the declarations page from your current homeowner's insurance policy. Second, find the annual costs. Look at your property tax bill and find the total amount for the entire year. Don't look at the quarterly or semi-annual payment. You need the full 12-month figure. Next, look at your insurance declarations page and find the total annual premium. Third, let's do the math. Step 1. Add your total annual property tax and your total annual insurance premium together. This sum is the total amount of money that needs to be in your escrow account to cover your bills for 1 full year. Let's say your annual taxes are $4,000 and your insurance is $800. Your total annual escrow need is $4,800. Step 2. Divide that annual total by 12. This gives you the actual monthly amount you should be paying into escrow. In our example, $4,800 divided by 12 is $400 per month. Step 3. Calculate your maximum legal cushion. Take that monthly amount from Step 2 and multiply it by 2. In our example, $400 times 2 is $800. This is the largest cushion your lender is legally allowed to hold. Now for the moment of truth. Look at your most recent mortgage statement and find your current escrow account balance. Lenders are required by law to perform an annual escrow analysis. If they find you have an overage of $50 or more, they are required to send you a refund check. But here's the secret. You don't have to wait for their annual analysis. If you've done the math and suspect there's an overage, you can request an analysis at any time. Let's say in our example, your current escrow balance is $3,000. Your lender is about to pay your $4,000 tax bill, and they're collecting $400 a month. You can see that they are holding far more than the $800 cushion they're allowed. This is when you pick up the phone, call your mortgage servicer, the number is on your statement, and navigate to the escrow department. When you get a person on the line, you can say something like this: "Hi, my name is your name, and my loan number is your loan number. I've conducted a personal review of my escrow account based on my current property tax and homeowner's insurance bills. My calculations show that my current balance appears to contain a surplus well above the 2-month cushion permitted by RESPA. I would like to request an immediate escrow analysis to have my monthly payment adjusted to reflect the actual costs. And I'd like to request a refund for the surplus currently in the account." By using terms like RESPA and 2-month cushion, you signal that you are an informed homeowner. They are legally obligated to look into it. This single phone call could result in 2 fantastic outcomes: a lower monthly mortgage payment moving forward, and a check in the mail for the overage they were holding. It's your money. It's time to claim it. To prevent this from happening year after year, you need to be proactive. Anytime you make a change, you inform your lender. If you switch to a cheaper insurance provider, don't just assume your insurance agent will notify them. You need to be the one to send a copy of the new policy's declaration page directly to your mortgage servicer's escrow department. If you successfully appeal your property taxes, send the updated assessment letter to them immediately. And when you get that annual escrow analysis statement in the mail, don't just file it away. Open it, read it, check their math against your own. It's the ultimate verification that you're only paying what you truly owe. And with that, we've reached the end of our journey. Over these 10 parts, we have dismantled the idea that your mortgage is a fixed, unchangeable burden. We've shown you how to attack it from every angle. We started with the heavy hitters: refinancing to slash your interest rate and recasting to lower your monthly payment without changing your term. We explored the power of strategic extra payments, turning years of debt into dust. We uncovered the hidden savings in shopping for homeowners insurance and the precise moment you can finally eliminate expensive private mortgage insurance. We've looked at leveraging a home equity line of credit and navigating the complexities of a loan modification. And today, we've empowered you to audit your own escrow account and reclaim your own money. Your mortgage is likely the single largest debt you will ever have, but it does not have to be a life sentence of maximum payments. It is a dynamic financial instrument, and you are the one in the driver's seat. You have the power to negotiate, to optimize, and to conquer it. The knowledge you've gained through this series isn't just about saving a few dollars here and there. It's about fundamentally changing your financial trajectory. It's about freeing up hundreds, even thousands of dollars every month that you can use to invest, to save for your children's education, to travel, to live a richer and more secure life. The system is complex, but it is not unbreakable. The tools to reduce your monthly mortgage bill have been here all along. Now you have the playbook. You have the strategies. The only thing left to do is take action. Go take control of your mortgage, and in doing so, take control of your financial future.